Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Verizon was founded in 1984 when at&t was ordered to break up the Bell system into 7 different companies. One of those companies ended up becoming Verizon. Verizon specializes in telecommunications, and they are most well known as a cell phone service provider. Verizon's operating segments include consumer, business, and corporate/other. In the largest segment was consumer, which earned them 68% revenue for the year. Each of Verizon's operating segments grew at roughly the same rate between 2018 and 2019. Verizon is currently the 16th largest company in America and is valued at $234 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Verizon earned $2.42 per share. In 2015, that number jumped up to $4.37 per share, which was an 81% increase. In 2016, their earnings per share decreased down to $3.21, which was a 27% decrease from the previous year. In 2017, they earned $7.36 per share. This was a 129% increase from 2016. In 2018, their earnings dropped back down to $3.76 per share, which was a 96% decrease. And in 2019, they earned $4.65 per share, which was a 24% increase year over year. This data indicates that Verizon has grown on average 14% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of June 14th of 2020, Verizon was trading at $56.53 per share. This represents a trailing 12-month price-to-earnings ratio of 12.7. This is lower than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of this recording was 21.8. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of June 14th of 2020, Verizon was trading at $56.53 per share. This represents a 4.16 trailing 12-month price-to-earnings growth ratio. This indicates that Verizon may be overvalued if this is the sole metric you use to value the company. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of June 14th of 2020, Verizon currently offers a dividend yield of 4.55%, paying 61.5 cents per share per quarter. Verizon most recently raised their dividend in July of 2019 when they increased it from 60 cents per share per quarter to 61.5 cents per share per quarter. Verizon over the past 5 years has increased their dividend by an average of 3% per year. Verizon's dividend payout ratio is currently 12.8%. This is pretty low and indicates that they have some room to grow this dividend payment in the future. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price-to-book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt-to-equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt-to-equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt-to-equity ratio is not necessarily a bad thing. As of March 2020, Verizon had a book value per share of 14.54. This represents a price-to-book ratio of 3.89. As of April 2020, Verizon had a debt-to-equity ratio of 2.02. This is on the higher end for companies in the Standard & Poor's 500. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Verizon stock on June 1st of 2017, held it for 3 years, and reinvested all the dividends you received, you would have seen an average annual return of 11%. If you had bought Verizon stock on June 1st of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 7%. And if you had bought Verizon stock 10 years ago on June 1st of 2010, held it for all of those 10 years, and reinvested all the dividends you received, you would have seen an average annual return of 13%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Verizon a A-. In my opinion, Verizon's main competition is at&t, and currently I think there's just enough market share going around right now that Verizon should continue to post solid earnings over the next few years. As a growth investment, however, I am not too fond of Verizon. I gave them a C-. Personally, I think that maybe they have a little room for growth with the new 5G that they're rolling out. But really, I don't think there's a whole lot of room to grow as a cell phone service provider, and I would be shocked to see much growth over the next few years. As for Verizon's value at their current price, I gave them a B+. Even though I'm not too happy with their growth, I really like their dividend yield right now, and they have a pretty low dividend payout ratio. Verizon looks like a really good dividend stock, especially at the price that they're at now. As an overall investment, I gave Verizon a B. Like I said, I don't think Verizon is a great growth investment, but I do think that they are a pretty solid defensive investment and one of the best dividend stocks out there right now. So I think for over the long term, Verizon will perform pretty well, especially if you reinvest their dividend. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.